Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value, and today we're going to go over portfolio allocation and the second portion of what I think is the most important thing to understand as an investor. The first thing is, and I'll just kind of go over it, a lot of these investments that we look at, commodities and the sectors that are in commodities, they only work during a period of time. It deals with the real estate cycle, which is AKA the business cycle. It's the same thing. During these portions, you can nail the cycle right, but you still don't make a lot of money. And that is where portfolio allocation, how to select companies it's very important. It is probably some of the most important things as an investor is how do you play the bull market? Do you play it with large companies? Do you play it with these small caps? How do you play it? What's valuable is to know how to play it. So the first thing is to identify when they work. Business cycle, real estate cycle, I've got a ton of videos on that. The second portion of it is how do you set up a portfolio to actually take advantage of it? Now, this is going to be completely different amongst certain people. Your circumstance may not be my circumstance, which may not be the other person's circumstance. Some people want to leverage up the risk. Some people don't want to have a lot of risk. What exactly is risk? I'll try to explain the way that I view it, and I think that everyone views this differently. It is a highly debatable subject, and this section, or what I'm talking about, is what separates very good investors from crappy investors. And there's traits that crappy investors all have, and there's traits that really good investors all have. And that is where it kind of separates the two. And it's the ability to figure out what vehicle to play it with. And I'm not talking about leverage. I'm not talking about options. I'm not talking about any of that stuff. So I'm going to describe a little bit how I set up my portfolio. Not that I know everything. Not that my portfolio is the ideal portfolio for someone else. But I'll just describe my thoughts and why I basically came up with the portfolio I did. And then maybe a little bit about the companies and a little bit about risk. So I'll start off with my viewpoint on how I'm playing the bull market in commodities. So let's dive in. I've got this here behind me. What this is called is Exter's pyramid. Let me see if you guys can see this. I just want to make sure it's in the view there. Exter's pyramid is basically, it's this pyramid here. And on the right-hand side, you've got more trust required, less liquid, harder to sell, further away from real wealth is this top portion. Then you go all the way to the bottom. And this is where less trust is required. It's more liquid, it's easier to sell, and it's closer to real wealth. So they've got derivatives, unfunded government liabilities, non-monetary commodities, private business, real estate, corporate and muni bonds, securitized debt, listed stocks, government bonds, treasury bills, paper money, and gold. So one portion of my portfolio, which is a large portion of my portfolio, is physical metals. The reason it is physical metals is this Exter's pyramid is because I want to get a good chunk of my wealth closer to real wealth, closer to stability of a portfolio. So if I think that physical metals are cheap and they don't carry a lot of risk, and I'll go over what risk is, but they are closer to real wealth, they're closer to liquid, there's no third party risk, there's none of that crap associated with it, I want a large portion of my wealth in what is considered to be the least risk stuff in the world. And if I can buy this at a time where gold, silver, platinum, palladium, or whatever is at a very cheap price to other assets, well, I'm going to load the heck up in it. So I own a good chunk, and I don't want to tell you the percentage because people get too fixated on the percentages. When it's cheap, I load up on it and I buy a lot of the physical metal, and that's kind of my staple of the portfolio. If the staple of the portfolio is cheap and it's cheap against other assets, well, that's exactly when you want to load up in it. If we're in a high interest rate environment where maybe government bonds are a good spot to be, for example, in the 1980s, government bonds were a great spot to be in the early 80s, mid 80s. And I'll go over what that looks like here real quick. So I'm just going to use TLT. Well, it doesn't have that. We'll use the TNX, which is the yields. So a bond bull market is when you have high yields and they decline to low yields. That's a bond bull market. So one could set up a portfolio where you could get paid in bonds up here 14, 15, 13%. This is a great spot to be buying a whole bunch of bonds and using that time frame. This time frame here is the bond market time frame. So you could load up during that time frame in government bonds where they pay a gigantic yield to you and the price of the government bonds would go up. That is when you want to do it. But now, since we have basically went to a increasing interest rate environment, this is where government bonds go down. Their prices go down when yields go up. So this is where gold does really well. So the staple of the portfolio in terms of low risk, I stapled it to gold and or government bonds. That's the 40-60 portfolio. The 40-60 portfolio worked for government bonds because of the pricing of what bonds have done and where yields have gone over the past 40 years. A declining interest rate environment pushes government bonds higher. An increasing interest rate environment is generally where gold is favored. And since gold is cheap, I want to be put in gold instead of government bonds. So the 60-40 portfolio has swapped because of the interest rates in the market. So when interest rates go down, government bonds is the staple of the portfolio in that type of environment. And I agree with it. Now, since we have an increasing interest rate environment, in my opinion, the staple to have, which is the stable portion of the portfolio, is physical metals like platinum, gold, and silver. So that's my stable portfolio that I hold a big chunk in. Now, when I go and I try to compare an investment, I have to beat gold. I have to outperform gold for me in order to take the risk, because I am comparing my portfolio against the least risk thing. And if I can't beat gold, there's no point in me trying to beat gold and take on more risk if I can't do it. So if I can't beat gold and I can buy gold at a very cheap price, or silver or platinum, I load into those metals because of the risk reward. Because it's less trust is required, it's more liquid and closer to real wealth. And if that can go up a gigantic amount of money, that's where I'm going to put the majority of my money. So in a 40-60 portfolio, it'd be 40% bonds, 60% stocks, something on the lines of that. As you age, you get more and more money into bonds, is what they will tell you. But what I am doing is I'm putting more and more money into gold and using ratios to push my returns. That's a big portion of it. Now, what is risk? Risk, in my opinion, is something occurs to your investments that is undesirable. So risk is, and it happens a lot in mining companies. Risk is something like a nationalization of a mine. That is risk. Risk could be dilution of shares. It could be going bankrupt because they have too much debt and the commodity price fell on them. It fell down below their cost curve and then they go bankrupt. They can't afford to continue the mine, or they start losing money. So risk is there's thousands of different things that compose of risk. In my opinion, the way that I kind of break up risk is, do they have the ability to generate cash? That's one of the questions I ask. If it is no, you are in a riskier company that cannot generate cash, because they're basically just using your money to fund stuff as an investor. It's more risk because there's no way that you're going to get a return. You are speculating on that sector and money to come into that sector and into that company, which are all developers and all explorers. They're inherently more risky than a producer. So they are a lot more risky because they have no way to generate cash to pay you as an investor. Then you've got a little bit less risk, still very risky compared to gold and all these other physical metals. So you have the producers that have infrastructure in place to produce cash. Those are less risky. They have the infrastructure. They have the employees. They have things in place, systems in place, safety stuff. It's all in place. So those are less risky because the infrastructure is in place and they have a way to generate cash. All they're waiting on perhaps is the commodity price to go up, and they are a leveraged way to play the price of the commodity. And then you have the size of those companies and their cost curves. So you can have a low cost producer which has very little debt, which is a big company. They have the infrastructure in place. That is less risky with an operating mine. Their licenses are all good. They've been producing there for a while. There's less risk there than a company that has no production, no mine in place, and all they are is exploring. There's more risk because the country could change its mind and yank the license from that company that when they go to develop a mine, they might be like, no, we don't want to do it. They change their mind and they say, no, we don't want to do it. Or there's jurisdictions where there's more risk because they don't have a mine. Now they're thinking about doing a mine. They've done exploration on it and they change their mind and say, we don't want to do this. Versus a country that has a bunch of mining already and they kind of know like what the outcome is if a mine gets built. So you've got all these different types of risks associated with the companies and where the commodity price is at. So you've got the big low cost, low debt producers. They're going to have the least amount of upside because the change or the delta in their margins when the commodity price goes up has the least amount of torque to the price. The higher cost companies that are in commodities have the most amount of torque upside movement because their costs are higher. Their margins get squeezed more as the commodity price goes down. And as the commodity price goes up, their margins expand faster than a low cost, low debt company. So the highest torque companies, the ones that do have inherently more risk of going bankrupt or whatever, are companies that are higher debt and higher costs. So those are the differences. The way to play it is a mixture of sprinkling money amongst all of those different companies. So when you find a cheap commodity that's down, So let's say you're using a ratio, you find a cheap commodity that's down. So let's do the gold to oil ratio right now. All right. So here's the gold to oil ratio. This is history. Historically, a really cheap ratio is 30 to 1. That is where it's really cheap. You get above 30, crude oil is really, really cheap. Now it's a matter of when is it going to turn back around and how much will I make? It's not a question of, well, maybe oil, no, oil is dirt cheap. It has to go higher. Like that is, in history, when you hit 30 and above, it's just like that's the time you load up. So right now, if you were to look at the ratio and you have gold to oil ratio, it's at 28.4. That is the ratio of that commodity. So what is that telling us? It's telling us that crude oil is cheap. Then you could say, are we in a commodity bull market? Yes. We're getting a pullback, which is wave 2 in the commodity bull market. So then you say, okay, how do I want to express my views in the investments itself? What should I do? Well, that depends on the person. Do you want lower risk where you want to go into a large company that has low debt and low cost? Your upside's not going to be as much. Well, that's what you're going to have to determine on what you want to do there. At 28.4, and it was 30 almost a few days ago when it was bottoming out. Well, I mean, if you're at 30, why would you not take a higher risk company, which doesn't mean that it's super high risk where they can go bankrupt, but a company that might have a little bit more upside potential and a little bit, and you're buying it at a very good opportune time where there's minimized downside risk. So that's kind of what you're balancing. You're balancing, and I'm just going to draw on this so you guys can see what I'm talking about. What you're balancing, and this is, just think of this as a blank sheet of paper. You have a low risk company where, let's say this is this is risk. All right, risk is your x-axis over here, or your y-axis. So you've got downside risk here. Here's your risk. Here, let me do this. So you've got your downside. This is on this axis here. This is risk. All right. So you've got little downside risk, and then your other company, you have little downside risk, but your upside potential on the big cap is here, and then your smaller guy with high leverage, your upside risk is that. So this is a medium to small cap company, and this is your big cap. So your upside, your symmetry in this is way bigger on your mid cap than it is on your larger cap. So what I try to do is I try to scale into this type of setup when the ratio is cheap and your risk reward level, your risk is roughly the same as a large cap, but your rewards are lopsided for the mid cap producer. The mid cap producer still has the infrastructure in place. They've got operations and employees. It's just a smaller operation with higher costs. Think of it as a swing producer. So I'm going in the higher cost swing producers because I have a viewpoint that is bullish on the commodity itself. So you can go into this company, and there's nothing wrong with going into, say, like an ExxonMobil or a Chevron versus a smaller mid-cap company, but your symmetry isn't as big. You don't have the reward versus the risk. Your risk reward symmetry isn't 10 to 1. It's like 4 to 1. And some of these, like ExxonMobil, they may not even be able to beat gold. So if I were to take the risk in ExxonMobil, well then why don't I just buy gold, because gold is even less riskier than ExxonMobil. And that's where it gets really difficult for me to distinguish between a large cap company with not a lot of upside versus a physical metal like silver. because silver is going to have more upside than ExxonMobil. So if we were to yank that up, just to show you guys what I mean, in the 70s, Exxon was a small company, but today it's a large cap company. And I were to throw something like, here's gold overlaid on it, and here's silver overlaid on it. And you can see, last bull market, here's ExxonMobil at the bottom there. Why would I not just invest in gold and take the gold? The gold. Like, gold's a better investment than ExxonMobil, so I would rather put more money into gold because of the risk reward than ExxonMobil. But if I were to throw a small cap up here, and I'll throw up SM Energy just because I've talked about it before. Well, SM Energy has this gigantic move that goes over ExxonMobil and goes far greater than gold and silver during that last commodity bull market that started in the 1998 timeframe. This here would be, this is 2,000%. But it's a 20 bagger, basically. And that is how I would maybe express my view, is the way that I would set up the portfolio it might not have any of the large cap oil gas producers because they just don't have enough leverage. And if I'm buying it at what I consider to be the most opportune time in the market, then I'm going to load up in these smaller mid-cap companies that have infrastructure in place that can generate cash and have all the leverage to the upside. And I'm using the timing of my buying to reduce the downside risk and have a bunch of upside potential. So what I'm doing is I'm balancing my holdings between the physical metals and these smaller mid-cap companies that have infrastructure in place with cash. Now, would I choose a company that is a large cap with a bunch of upside potential? Yes, that is the sweet spot. You want to minimize your risk as much as possible, and you want to maximize your upside potential. So you get this gigantic risk reward imbalance, which is what I'm talking about here. Over on this side, it's if your risk is the y-axis, and let's just say your downside's here, you buy it at a really low point, and you've got this big upside potential. And let's say you've got upside potential that's like this. This is a small cap, and this is a large cap. All right, large cap, small cap. All right. So your difference in your symmetry here versus your risk could be on a small cap be something like this, right? So you've got more downside risk in the small cap versus your large cap that has very low downside risk, but you've got roughly similar upside potential. So now you're balancing this risk difference here. So you're taking on, maybe this is this is one full unit of risk, and this is only a quarter unit of risk in the large cap. Here, you've got very small difference here. Let's say this difference here is only like 1/10, where you think like you might have a little bit more upside in the small cap versus the large cap. That's where it's not worth taking on that extra risk. And what a lot of people are doing is they'll have a small cap that has upside potential like this. Maybe it's a little bit more, but their risk is something on the lines. Hold on. I just got to get rid of this real quick. Their risk is something like, oops. Their risk is something like this. So they've got this gigantic risk, or maybe even the risk looks something like this, right? So they've got all this risk down here, and then they've got the upside potential, but it's not skewed. It's not like a huge asymmetric bet. This is your exploration company with no production, and they have to dilute you to death and all this other stuff, and it may not track the return of the commodity because they just dilute you to death, or they can go bankrupt because they have debt. So the way that I would view it is, I don't want to take on the extra risk. How about you just give me the large cap company? Give me the large cap company because the risk reward is skewed in favor of the large cap. So you want to set up a portfolio where you get large upside potential and small downside risk, and you want to migrate to the less risky options. The problem that retail investors have is they go pile into all of the risk, and the delta in your rewards is not that great. You don't have the symmetry isn't big enough to justify the risk. So what they do is they lose money. They go to a company that needs to be funded with their money. The funding comes from your investment. You're not in a large cap that's paying you a bunch of dividends and has a bunch of upside potential. So the way that you want to look at things is from the symmetry. The symmetry. What is my risk reward asymmetric bet in this investment? And retail investors take far too much risk. Far too much risk. Like it's off the page risk. They hear a company, they get married to a story that is on YouTube, and then they're like, oh, I want to invest in that. Too much risk. Too much risk. And then they want to go into other companies like ExxonMobil, and it's like, you're taking on too much risk there too. Because the rewards are not there for ExxonMobil, I would just rather go buy physical metals. There's less risk and more upside potential. So the way that I view the stock market is it's a way to, in my opinion, if you're going to try to play this commodity bull market, you're going to have to find enough upside potential to justify any risk that is taken outside of the physical metal itself. If you can't beat the physical metal, then why the heck are you buying that company? So, I mean, we can look at like some of these other companies here. I've got gold still up here. Well, we can reprice it in. Here's Camco. So here's Camco. And then if I were to compare it to just say like gold, and there's gold, I mean, it's not like, I mean, Camco has outperformed gold, so it could be worth going into. So, I mean, that is kind of stuff that you want to look at when you're looking at these potential investments. Can I beat gold, and how much risk am I taking on to do it? If the answer is yes, I can wax gold, and there's not all the risk in the world, it's a good investment, in my opinion. If you can't really beat gold and you're taking on risk, I wouldn't do it. I just go buy the physical metal. That's the way that I view it. So you can nail the timing. You can say the ratio's cheap, platinum's cheap, crude oil's cheap, but then you have to figure out how you want to play it on the other side of the thing. In my opinion, you have to find something that provides a greater asymmetry than the physical metals themselves. And the risk in the physical metals are like nothing. They're very, very low. You have no counterparty risk. They're super liquid. They have good upside potential at these potential areas. So now you're going to have to take on enough risk where the symmetry carries you way to the upside. You're going to have to get a 10 or 20 bagger because I think gold can go up 4, 5, 6x. So that's where you're going to have to, that's what you're balancing. That's the game. And what most retail investors do is they take too much risk. They go into small junior companies where even the upside potential is questionable. And then they have all the risk in the world. I would ditch all of those companies. If you don't have the upside potential, there's no point in being in it because of the risk. I'd rather go buy the physical metal itself. Some people think there's upside potential, and that's where the difference between experienced and unexperienced is identifying what the potential upside could be. I don't think there's that many investments in the marketplace that are that great of an investment to take on the risk. So now you're sifting through small, mid cap, and large cap companies with infrastructure in place that can generate cash. And that is where you want to play. And you play the physical metal. You play the ratio game that I've showed on this YouTube channel with the physical metals. And that's how I play it. That's what I'm looking for in this commodity bull market and how I'm structured the portfolio. If you do place bets on higher risk companies, I don't allocate as much to them. So I might allocate a 1 or 2% position in that particular portfolio to a company that may have a lot of risk. And then a larger cap company that pays a dividend, that has infrastructure in place, that still has 10x upside potential or more, and they're out there, then I might allocate 4, 5, 6, 7, 8% positions to them. Much larger position size. So you're controlling risk with position size. That's how I do it. If you want to know the companies I'm in, if you want to know what's high risk and low risk, I break that down for you at the website. That's what we talk about, is the companies, why I'm piling into something. And what I'm doing is I'm looking at the company's risk reward, and I just say, look, this is too big of an upside potential for the risk that we have at the current price. The value is in the commodity, they're down. And then I buy and load up into it. And that's where the value is. It's the value of identifying what's cheap, and then the value of actually the vehicle to play it with. That is what you have to get really good at. Warren Buffett talks about a moat. A moat it's a barrier to entry, basically, of a new company to try to take market share from another company. That moat can be in a variety of different things. Like offshore drilling. Offshore drilling, there's a moat around it because the barrier to entry is the equipment that they're using. But that cuts both ways, though. It cuts both ways. That's also going to limit the growth of the companies that do have the equipment because they can't just expand it. So if we get in a really tight, and some people, they ask me this, a lot of people think that the offshore drilling is going to, the day rates are going to go way up. And I agree with that. I'm in those companies. But here's another thing. If you can't build a lot of it, that means that the growth of offshore will also be limited if you can't build these things quickly. Which then also means if you get in a very squeezed situation, that I think onshore is going to do very well as offshore, because you can't just pile on to the offshore. So now they're going to have to find other ways to grow production that isn't offshore if they can't make these things quickly. But I think onshore is also another good bet because they can't make the offshore equipment that quickly. So there's all these different ways that you can play this commodity bull market. I think I've got most of it nailed down. You're still going to have to live with volatility. Volatility isn't necessarily risk. Risk is the total loss of your position. That is the risk that you have with some of them. I don't think you'll have total loss, but you'll have volatility. That volatility is there no matter what. It's in ExxonMobil. If we look at ExxonMobil and even Camco here, but ExxonMobil still has volatility in it. I mean, this is a big move from $100 all the way down to $32. This is a big large cap company that got smoked to the downside. Now, if I were to put SM Energy on top, and obviously this was a 90+% decline, but if I'm sitting at a ratio of greater than 1 to 30, it's like 1 to 50, which is an anomaly, and we're at this location. Let's just say we're at this location down here. Why wouldn't I choose SM Energy, which has a risk reward level far greater than ExxonMobil does? Your symmetry isn't favorable for ExxonMobil at the bottom here. So that is exactly what I try to do, is I try to identify those companies that are just huge upside potential with lower downside risk. But your downside risk is still going to be volatile. It's still going to go up and down 30, 40, 50, 60%. Even from a very low level, it is possible because the company is just that volatile. But your upside potential could be 50, 60, 70x. And then you're bouncing that off of what is your risk reward potential? How are you balancing this all out? So that is the vehicles that you're trying to play it with, and it is incredibly important to choose the best vehicles possible in the risk reward setup at very ideal locations. That's the whole name of the game. The whole sector is going to move together. Like I have behind me in ExxonMobil, this went up the same time that this went up. One just did it at a much steeper pace than the other. The way that you got that steeper pace, the way that it fell 90+% is because of the debt it held and the break-even point on the company. That's why it fell so much. It got sold off to pennies on the dollar because people were worried that it was going to go bankrupt. And that's where you have to manage your risk reward and look at the company and say, it's not going to go bankrupt. So that is what you're balancing. I'm trying to get a portfolio set up of these types of companies, and maybe they're less risk than SM. These types of risk reward companies in the portfolio across a bunch of different sectors, where if the sector's in favor, it'll carry and pull your portfolio upwards, while another sector may be out of favor at that time. And then that's what balances it. The symmetry is what pulls the performance upward. Your downside risk is being mitigated of when you purchased it based off of the technical analysis and the value of the commodity in relationship to other commodities. But you're still going to have to ride through volatility. You'll never get away from volatility. Even in ExxonMobil, you have volatility. That's just part of the game. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. That's kind of how I view this stuff. You got to beat gold. If you can't beat gold, you just go into gold. If you can beat it, then you have to start looking at your risk reward symmetry. How much risk are you taking? What's the potential upside? And are you buying it at an opportune time? That's the whole name of the game. All right, guys. That's what I've got for today. We'll catch you later. This is Finding Value.